Rachel, you there?
Yes, I am here. I apologize. I'm getting some weather, so it's a little
Oh,
dicey in
where
the
are
southeast.
you?
Yeah, I'm in south of Georgia.
Okay. I'm currently in Florida.
Oh,
So we
really?
had some weather, but but it's not I'm on the west coast of Florida. So
Gotcha.
yeah, it's windy. I'm looking out the window right now of the hotel room. It's windy, it's rainy, but it's not like cars aren't flying through the air, so we're all right.
That's good news. Yes.
Yeah. Awesome. Well, thanks for being here, Rachel. I'm excited to do this.
Yay. So am I. So am I.
Awesome. So, everybody, I'll just do some housekeeping real quick. We are recording, we are streaming on LinkedIn. You will get an email afterwards that gives you the recording of this, and you can feel
Oh,
free to share that with whoever you want. What we're going to talk about today are some of the most popular and effective ways to make money in real estate today. So there's tons of ways you can make money in real estate, right? Like 30, 35 different ways you can make money in real estate. I'm at an event right now where everyone in the room is doing something in real estate. There's so many ways, but Airbnbs, short-term rentals, super hot topic, and multifamily, super hot topic. So we're going to cover those. And what we're going to talk about is how both of those work. Um, so we'll each do an intro and talk about the type of investing that we do, how it works, who it's great for, and when it's great for them. Okay, so if you guys have heard of the concept of the circle of wealth, um, there's so many ways you can make money in real estate in the world. Some is active, some is passive. And so you really want to get your active income high, keep more of it with tax strategy and asset protection, and then grow it with some passive investments. So there's certain times that it's good to do, the short-term rentals. There's certain time when it's good to do the multifamily. So we're going to talk about that, how inflation affects that, interest rates and markets and everything. But first, before we dive into it, Rachel, I'd love to give you the stage and have you introduce yourself to the people on here, because half the people, actually in the chat, everyone, put Rachel if Rachel invited you and put Sarah if Sarah invited you. That's always fun to see. And then Rachel, go ahead and introduce yourself and before I take over the stage.
I love it. I see some in the chat that are saying both. So I'm super, super excited. So this is such a timely topic, isn't it, Sarah? We're going into the end of the year. We're looking, how do we maximize our tax savings, our tax benefits, and our cash flow? And honestly, I felt that multifamily syndication for a very long time had a lot of those advantages, but we're seeing those in short-term rentals as well. So I can't wait to dive in. But for those of you who have not yet met me, my name is Dr. Rachel Gainsbrugh. I'm a healthcare professional. I say by day, I am consulting. I'm a real estate investor by night, and I operate primarily in the luxury short-term rental space. And I'm primarily a minimalist, where I'm looking at how do I own and operate the fewest number of properties that generates the highest profitability. And the reason I have that approach and the reason I coach on that approach, Sarah, is primarily because I'm a mom, a medical professional. I got a whole husband, two dogs, three dogs, two kids. And so when you say when is a good time, you really have to look at your own individual situation. Do you have time? Do you have an exorbitant amount of time? I don't know a lot of those people who do. Or do you want to leverage, your time in a different way so that you're not exchanging your hours for dollars day in and day out? That is not sustainable. And so that's why I absolutely love real estate. I absolutely love that you're at a conference right now where you're seeing all aspects and all types of investing, but figuring out what's going to be the best fit for you is key. So once we, got over the hurdle of paying off our student loans, we had the great pleasure of, delving into our first real estate investment, and then we were hooked. And so I have just been spreading the message of real estate investing ever since. Have had the great pleasure of going on different podcasts, Sharon Lecter's Woman Investing in Real Estate, Rich Dad Poor Dad co-author, as well as Amy Porterfield, just talking all things real estate, all things passive income revenue streams. I absolutely, absolutely love that. As a matter of fact, one of our properties were so profitable that one of the data tools that we use to evaluate reached out with a casting company and got us featured on a Netflix TV show out of nowhere. So this is a girl who's in healthcare, know nothing about media. And, we just were on a Netflix TV show that just aired in September. Buy My House, got a cash offer on TV, which it's like a Shark Tank-esque with the CEO Red Finn, Barbara Corcoran's group. It was just such a blast, totally unexpected. And so that's a little bit about me. Again, healthcare professional, a mom, whole wife with a whole husband with kiddos and doggies and all of the things. And it's just such a great pleasure to be here with you today, Sarah. And I can't tell you how excited I am to be here because you provide educational series month after month after month. And I know the time, the energy, the effort that it takes to think these things up and to put them together. And I cannot thank you enough for having that heart of a teacher, because I always walk away from your series much more knowledgeable than before. So I thank you so much for having this platform and for inviting me here as well.
Well, specifically why I invited you is because a lot of people say, hey, I want to do an Airbnb. And normally when you look at the margins and you look at the ROI on your time, I'm like, you could do that, or you can go investment and you make the same amount of money, but with work. But with what you do and the way you do it, you get a much higher profit margin than a lot of people who do Airbnb. So I always go back to, like, you got to make sure that you're looking at someone who's where you want to be and, listen to them, get coaching from them and do what they're doing. And so I love people who ask me, like, hey, I'd like to do Airbnbs. And it's like, hey, don't follow the person down the street who's doing it and getting, like these thin margins, these thin ROIs with a lot of effort. Go find the people who are doing it with a small amount of time and a high ROI on their money. And you want to do it the way they're doing it, which is what you're doing. So I'm glad you're here. I'm going to ask in the chat, who here knows what a short-term rental is? Put STR in the chat. Well, I think everyone should know what short-term rental is, but just want to make sure. And then I also want to ask, who knows what a syndication is? Multifamily syndication. Put multifamily in the chat. I got a nope. Nope. I got nope. Yeah. Okay. Cool. So some people do know. I'm looking at. Sorry, guys. I forgot my glasses on this trip, so I'm like trying to read the chat. Okay. So some people know both. Some people don't. What I'd like to do, if you don't mind, Rachel, is take over the screen and just for like 10 minutes explain what multifamily syndication is. And then I'd like to go into, current events like inflation, interest rate markets, and talk about each of our investment styles and how these current events are affecting each of our investment styles. Because that's like what everyone's asking you on the phone, right? When they talk to you or when you meet up with your friends, everyone's asking you, how is inflation? Here everyone's, how is inflation affecting this? How are interest rates affecting this? How are markets? So let's just talk about that and compare the two. I think that would be great use today. All right, everyone. So I'm going to share my screen and I'm going to quickly run through what is a syndication. Okay. Oh, sure. Okay. So we're all on here because we want to learn about investing. We want to make more money. That's why you guys are on here, right? Not to make less money. So I always say, hey, if you want to make more money, if you want to be wealthy, you have to do what the wealthy do. So the wealthy earn more active income, they keep more of it with tax strategy, asset protection, and they grow it really smartly. And so what we're talking about today is, hey, active income, passive income, that first category, that last category, real estate can do both of those for you. And so short-term rentals and multifamily syndications are kind of like bookends in this equation to amplifying your wealth and doing what the wealthy do. So Sugo Capital, we connect investors to passive income opportunities, but I love doing stuff like this where we have Rachel on talking about some other ways that are not strictly 100% passive, that are more active, because I am 100% fan and teacher that you should diversify your portfolio and invest in what's right for you. But we specifically at Sugo Capital, we only do passive income opportunities for investors. We have 450 million worth of assets acquired over the last few years. Our average annualized return for investors is 33% on the 6 properties we've exited, and we've acquired 22 properties. And I'm throwing this in here because it's my kids, and all of you who are, going to do short-term rentals, you're going to do some sort of marketing, put your kids in there so they can be, you can pay them and have an expense as part of your keep more strategy in building your wealth. So I do a ton of training on how to live your dream life. So your dream life, you're probably not there if you think about it, because there's some sort of financial gap, right? And whether that's a gap in active income or a gap in passive income. And so that's what we're going to talk about today, how to look at what type of investing might be right for you, set your goals and achieve them with real estate. All right, so this is what I just said, how it works, who it's for, inflation, how is that affecting these types of investment? How is the lending market affecting the ability to get into these types of investments and the markets? Okay, so I'm going to skip this one. How to determine what kind of investing is right for you. So you need to take a really good look at yourself before you say, oh, short-term rentals are perfect or syndications are perfect. You need to first take a look at, do you need passive income, or are you investing? Are your funds that you're thinking about, hey, I've got this money, do I buy an Airbnb? Do I go into a syndication? First, you need to decide, hey, am I using this money because I need passive income within the next year? Or am I using this to build my net worth? And so appreciation types of investments that have appreciation might be right for you. So really be clear with, why are you investing? Why do you want to get into real estate? Is it that monthly check or quarterly check? Or is it for, some life event that's going to happen in 5, 10, 20 years in the future? That's really going to affect how you make a decision. Really think about the level of effort that you have to put into your real estate endeavor, your investing endeavors. If you invest in something like a syndication, it's 100% passive. If you invest in, you get an Airbnb and you follow what other people do, you might be spending, it could be a full-time job for you. Or if you do it like the way Rachel teaches it, it's not a full-time job for you. But it still takes some of your time to get it all set up, but you want to do it efficiently. So those are all things you need to think about as an investor. Also think about the level of risk. So there's so many types of investing out there. And I think the two that we're talking about today and focusing on, short-term rentals and multifamily syndication, are some of the lowest risk if you make sure and choose the right market, which we're both going to talk about markets. Really, but there are other ways you could make way more money. They might be higher risks. So really think about that for yourself when you're deciding what to invest in, and then setting the goal. So some things you can do like within the next couple of weeks, some things you're going to be doing in a couple of years from now. So really setting clear goals after you go to this event, after we wrap up, is really important, and taking action. Otherwise, you wasted an hour. And we're not here to not change lives. We're here to change lives, right, Rachel? All right. Can't skip the disclaimer. So we're not making offers to invest in anything we have. The numbers that we're going to show you are for education, for examples, they're models. They're not investments. We're not saying, hey, give us your money. I just want to be really clear about that. Even though we're talking about investing and ways to do it successfully, there are risks associated with investing, including principal loss in any type of investing that you do. Okay. So multifamily syndication, I'm going to show you the structure, and know that this is a common structure. So this is what I do, but it's also what a lot of other people do. And so this structure can be applied to other types of real estate as well. So it can be applied to strip malls, a commercial retail center, medical retail centers. There's so many things that there's someone who's going to come in, they're going to buy it, and you can invest in it. So if you think about, hey, what's going on in the world, what's a strong asset class, you can most likely get into that passively. And here's how it works. So syndication basically means pooling people's money together. Make sure and watch my time. All right. Pooling people's money together in order to make a common purchase. So say this apartment building is $1 million. We go get a loan for 700,000, then we need $300,000 for a down payment. I'm simplifying it. So we could buy one of these, maybe two of these, maybe three of these, and then we run out of money from our bank account. So instead, what we do is we go out to investors and source that $300,000 from investors. So here's what it looks like from a capital stack. So what we do is we create an LLC, and that LLC, we place that apartment building in the ownership of the LLC. So that I don't own it directly, investors don't own it directly. There's an LLC that holds this apartment building. And so there are general partners in that LLC and passive partners, limited partners in that LLC. And so here's how we break it up. All right. So general partners, again, I said that's like me. So I'm on the loan, I'm guaranteeing the loan. Me and my partners, we're doing all the work. We're managing it. We're managing the property management company. Then there's limited partners. So potentially folks on here. So I've invited my investors to come watch. So you guys have all seen this before, but I'm putting it up here for people who haven't seen this before. So people who want to be invested in apartment buildings for stability, but they don't want to be on the loan. They don't want to manage the property management company. They don't want the tenants to know who they are. Those are the limited partners. So the capital stack to make this purchase, how do we break it down? So this pie represents all the money needed to make the purchase. So we get a loan, the gray piece for 60%. We supply some of it as the managing members of this, as the managers of this endeavor. And then say in this example, investors supply 30% of the capital to make the purchase. So then what we do is, how do we allocate ownership of the LLC? So we own 30% for doing all the work, and investors own 70% for bringing the money. And so this is really important to understand, because you can see they're not equal pieces of pie. 30% is smaller than 70%, but when we break it down like this, this creates a situation where investors get 70% of the capital gains at exit. And so there's a really strong back end on this type of investing. So this is really strong for people who are investing for, maybe 5 years from now, 7 years from now. It is great for building your net worth because for supplying 30% of the purchase price, you get capital gains on 70% of the property. So it's really fun. And it's completely passive. Passive investors do nothing. So I'm going to talk about some terminology, and this is important for both of our types of investments. So cash on cash, we're going to talk about this, like what's typical cash on cash that you can see in both of our investments. What that means is how much do you get monthly, quarterly, annualized return. That means once you exit the investment, how much cash have you received? How much appreciation? What's the total amount you've received in an investment divided by the number of years you were in that investment? And that's going to be your annualized return. So it includes cash flow and appreciation. So that's an important number to know, the difference between what the cash on cash return is. If you're looking at a syndication, you're going to want to check out, is it value add or is it new build? Because that's going to tell you when the cash flow starts happening. So, Rachel, we're going to talk about, when does cash flow start happening in short-term rentals? Is often much faster than going into like a new build of an apartment building. You're not going to get cash flow for 3 years. If cash flow is important, like now, short-term rentals could be your ticket. Accredited investors. So a lot of these group investments require that you're an accredited investor, which means you have an income of 200K or more per year, 300K or more per year with your spouse, or you have a net worth of $1 million or more, not including your home residence. Now, short-term rentals, Airbnbs, you don't need to be accredited, anything like that. You can do as you please. You don't need any there's no rules about who can do it and who can't do it. So that's great. It's really flexible that way. Targeted investment period. So group investments, you go into it with everyone, you leave with everyone. Short-term rentals, Airbnbs, you buy it when you want it, you sell it when you want it. So if you want more ownership around the timing of entering and exiting your investment, You can choose your liquidity timing when you're with a short-term rental. You're just owning it yourself. So know for yourself whether that's important or not. All right, minimum investment. So oftentimes in group syndications, it'll be a 50K or 100K minimum investment. And it's oftentimes not very flexible. If this does not feel good for you or it's not right for you, then, an Airbnb short-term rental is much more flexible depending on your market, how much money you're going to use to begin your short-term rental business. Okay, so in a syndication, your income is not, you can't control it. So the nice thing is you don't have to control it. The bad thing is you can't control it. So the example that I gave on the last page, I'm going to show you what that means if you take all that terminology and plug it into a timeline. And so that if you see one, you would know what that means for you. And then again, with short-term rentals, you can pull the levers. If it's not doing what you want, you can change something. You can call Rachel and say, hey, I need some coaching on how to up my cash flow. You can't do that if you're in a passive investment in a syndication. I mean, that's my job and that's what I'm always trying to do. But you got to be comfortable with who you're investing with because you're not able to do it personally. So in the example on the previous page, it said 8% cash flow, 5-year hold. So I did a 5-year timeline. It means you come in at year one, you put in 100K, you get 8K per year. Okay, so if it's paid monthly, you get $666 per month. If it's paid quarterly, you get $2,000 per quarter. Now, that's $40,000 over 5 years. That's not 20% annualized, right? But how we get to those numbers, when you see an annualized number, it means, okay, once the property sells, once the project sells, there's proceeds from sale. So remember that those two pies, and the green piece of pie in the beginning, that was 30% of capital, gives investors 70% ownership. That creates the situation so that when the property sells, you get a very nice appreciation check on the back end. So for example purposes, let's say the property is sold in year 5 and this investor gets $60,000. So that's their 70% portion of the capital gains. And they get their principal investment returned of 100. So if you take all the money, the 40 and the 60, and your 100K back, investors can turn their 100K into 200K in 5 years, taking the example on the previous page. All right. And then there's also historically, we're seeing a tax advantage of 30 to 100K. Now, I'm not making a claim that you can use this, but just know that there's a tax advantage, but they can only be used against your passive income. So Rachel's going to talk about, hey, can you do something with your active income? Can you use short-term rentals as to reduce your active income taxes? So in this case, it's a passive investment. So you can only use the depreciation and loss against your passive income. So if that's not a right fit for you, do some active things that can give you a tax advantage. This slide is cool because it applies to multifamily syndication and it applies to short-term rentals. So a lot of people say, hey, in order to invest, I need to have the money in my bank account. Oh, excuse me. This is from forget the talk to Marta. This is from a previous presentation I did a couple days ago. So ignore the things at the bottom. But a lot of people think, okay, I need cash in order to start. Well, that is one way. If you have an IRA or a 401k, you can turn those into self-directed accounts and you can use that to buy a short-term rental, to enter a syndication. So there might be pots of money out there that you can pool together, put into a self-directed retirement account and do one of these two types of investments. 1031 exchange. So if you have a property that you don't want to own anymore and you want to sell it, and invest in a short-term rental or a syndication, you can 1031 exchange into either of these types of investing. You can also leverage with a line of credit anything that you have out there that has equity in it if you're the owner. And a lot of people do that in real estate is they buy something it grows in value. They have some equity. They take out that equity and they buy another short-term rental. It grows in value. It appreciates. Rachel's nodding her head. I'd love to hear if you've been doing this and if you coach people to do this, but it's not very cool to say, hey, I bought this for 100. It's now worth 200. No, like take that equity, do something with it, turn it into cash flow, invest in something else. So there's all kind of creative ways you can get into the space. So I'm going to stop sharing right now and turn it over and say, based on what I just said, Rachel, is there anything you want to add to kind of go through your model and what you share with your coaching students?
Yeah, absolutely. And what an amazing conversation. I love that, how balanced you were, Sarah. You gave us our kudos where it's due, but you're absolutely right. So short-term rentals is definitely a hospitality business. And so when it comes to that, it's going to be understanding your personality, understanding who you are as someone who loves to either deliver hospitality, or if that's not your jam, partnering with those who can and are willing to do it as well. But I do have a few slides. It looks like my internet is working. If you don't mind, I would love to share.
Yes, please do.
Okay, awesome.
Okay, did that
All
work?
right. Yeah.
Okay, cool. Yeah, go for it.
Got it. Okay, certainly. Let me share this desktop over here. And if it starts to act up a little bit, I'll just continue with the conversation. So let me know if you can see my screen there, okay?
Yes, we can.
Okay, awesome. All right, so for me, of course, we want to finish the year strong, right? And we want to take as much advantage as possible. And so what I'm sharing is really the keys, the 3 keys to amplifying your short-term rental cash flow and finishing the year strong. And I love that Sarah talked about cash flow, because this is where I think there's a huge advantage with short-term rentals. It's not as passive, but the cash flow is definitely there, and it is definitely there early on. So that is what I'm excited about talking about. And so I already went through all of the things in terms of some of our experience. And it looks like my graphics aren't all showing, but it is all good. I have had the great pleasure of launching 22 short-term rentals with the luxury feel, have had the great pleasure of hosting over 3,000 five-star guests over the last several years, from 2019, end of 2019 to now, and have grossed over $3.1 million. But you have seen the disclaimer that Sarah shared a little bit. We're doing this for educational purposes. But what I want you to understand is I know what works and I know what doesn't when it comes to launching a luxury short-term rental. And that's what I'm excited about sharing with you today. Warren Buffett said it best, right? If you don't find a way to make money while you sleep, you will work until you die. And so that kind of gutted me when I saw that, because there was no way for us to increase our revenue while we're working in healthcare outside of punching a clock. We didn't know anything else, right? I did what I was taught. I did what mom told me, went to the good schools, got the big old degree, walked away with $500,000 of student loan debt, and just had to grind and punch a clock to create that revenue, or so that's what I thought. And so that's why I love real estate investing, because you do not have to do that. But there are 5 ways that we're leveraging right here, right now, to amplify our short-term rental cash flow. And so we are leveraging lending products. And I know that a lot of you are experiencing higher than expected interest rates. We're encountering faster than expected recession, or inflation rather. And looking at our lending products and looking at the lending products that are actually coming out of the woodworks for investors in investment properties, single family homes, and so on and so forth, has been very interesting. So what we're looking at right now, Sarah, are 2-1 type of lending products. I'm just learning about that. Right now, we have a market where, although, the home prices had skyrocketed, we have some seller anxiety. Sellers are willing to give concessions. So we are in a cycle right now where we can negotiate with sellers. Members in our community are putting in offers for under asking price. I don't know if you're seeing that as well in the multifamily world, Sarah, but I think that's really exciting that we can get great deals again because of those seller hesitancy, seller anxiety. They don't want to sit on the market for that long, and they've been sitting. So we can offer under asking price. So that is super, super exciting. For those of you who are saying, well, you know what, I'm going to sit it out. Think about that, think about that. Now is the time for the deals to be had. We're using advanced tax strategies that's allowing us to see anywhere from 80 to 200% gross ROI. As far as what we're investing, what we're putting into the property, our expected revenue, we're going to talk a little bit about those tax savings. We're using amenities. We can optimize amenities. When Sarah spoke a little bit about making tweaks and changes, and I know that with the multifamily, you have a lot of opportunities to do value add. You have many units, you can do value add across the board, but adding a fire pit, adding a pet friendly aspect to your properties. Pet friendly stays are the most sought after amenity and the most searched for amenity by guests who are traveling, and they're the ones that are least offered by hosts. So I'm dropping the gems right now. If you're not pet friendly, if you're not trying to be pet friendly or strategizing a way to implement a pet friendly environment, you're leaving a lot of money on the table. And just flipping that switch, figuring out who it is that you need, who's the best pet cleaning team in your town, to make sure that that property is in tip-top shape afterwards, can make all the difference. Direct bookings. So we do have fees that are associated with booking on what is called the OTA. So a big vocabulary word for you today if you're new to short-term rentals. OTA are the online travel agencies such as Airbnb, such as Verbo or VRBO, such as Booking.com. Those are called OTAs, okay? So the first time you get to host a guest, there are a lot of fees involved. The guests are paying fees, I'm paying fees. We've got taxes. There are a lot of, itemized line items that are getting paid for. And so what's coming into your pocket is not going to be the full booking payment from the guest. However, if you show that guest a wonderful stay, my friend Bill Faith says, the first time, the guest books you through an OTA, that's fine. The second time that same guest books through an OTA, that's your fault, because you can generate about 20 to 30% of a revenue increase when they book with you directly. You have to have the right systems in place to accept that direct booking, but it is so worth it, because overall we have seen for those properties, same property, Sarah, same property, book directly, book versus on an OTA, we're seeing 30% of revenue. And of course, your properties are they can present to be a shoppable experience. Think about it this way. Your properties are kind of like their own Instagram platform, for instance. And so now we have retailers who want to showcase their goods in our properties. They want to showcase their mattresses. They may provide mattresses for me. And if the guest loves the mattresses, because we tell you, we guarantee the best sleep, that you ever had. And because word for word for, I guess this is the best sleep I've ever had. If they want the mattresses, there's a barcode they can scan. The mattress gets shipped to them from the retailer, and you get it, $400 or 20% or 15%, because the retailer knows that the likelihood of people just walking into the mattress store or just they're there already sleeping in your bed, eating those snacks, enjoying the coffee machine. So we have partners with those retailers to give those guests the experience. And if they so choose, they can go ahead and shop them as well. So these are, I just spilled all the tea there. These are ways that we are amplifying our cash flow through short-term rentals. And that's why I focused on how do I own, I'm going to squeeze all the juice out of that one property. We're not going to go out and get like 50 some so-so properties. We're going to do it one at a time. That's what I teach my members. one or two at a time, because I really feel all you need is one or two to be just wildly profitable with short-term rentals. So those are some of the things that I did want to talk about. I have a few more slides. I can kind of fly through them. We talked about direct bookings. We talked about shop experiences, location, understanding your numbers is very, very important. And we have a variety of locations. And I had all these beautiful images. I can see them, but they're not showing, as far as glamping locations. We all know that that's a thing now, because when it comes to luxury stay, it's not necessarily, the accumulation of gold-plated toilets or anything like that, right? Do you remember Lifestyle of the Rich and Famous there? We were like, whoa, no, nobody wants that anymore. They don't want all that clutter. No one cares about that. They want to live like a local. They want to experience a unique stay. Okay. But one thing I do want you to understand, before we even run our numbers, we look at regulations. That's the elephant in the room. Regulations are ever evolving. And with Sarah's model, with the commercial multifamily, oftentimes you're not beholding to those regulations. Those regulatory bodies, commercial versus residential, it's very, very different. Okay. So understand that. So I'm just going to exit because I think my slides are just acting up right now, but I'm going to stop sharing screen.
Actually, we were able to see that. Oh, sorry. We were able to see that last one. I think that was a really good point, that start with the exit in mind. Can you at least talk through that one? Because I think that's so important for people deciding how they're going to move forward on an investment, is what's your exit strategy. So can you hit on that one?
Yeah, absolutely. So when it comes to walking into the deal, and what gives me, I would say, confidence in walking into this, kind of having a business plan in mind. So what is the worst that can happen? What is the best? What is the middle? What is the worst? When we're investing, we're going to put our investing hats on. It is not going to be an emotional, type of strategy, but we want to know, worst case scenario, what can I do with this property? And I'm human too, no joke. When I'm walking into certain investments, I get a little bit scratchy. I'm like, should I? But then I said, wait a minute, go back, look at your strategies, look at your exit strategy. So worst case scenario, can I 1031 exchange this property? Next, can I do a cash out refinance? Can I sell the property? And if I'm going to sell the property, I want to sell it not to break even. I want some money back in my pocket. So did I buy it correctly so that there's money in my pocket if I sell it? I'm walking in thinking, yes, short-term rental for life. We're going to be in this forever until no, life happens, right? So when I walk away, what does that look like? And so once I am clear, once I know, if I were to sell it, here is what I expect I would generate from it. Or if I were to keep it as a short-term rental, here is what I would expect. But then what's the middle ground? Well, if I were to keep it and now I need to transition it to what's called a midterm rental or a long-term rental, am I still able to pay my bills as I'm transitioning to my next best step? So those are some of the exit strategies that we look at, because, nothing is forever. Nothing's a surefire thing. Regulations change. We have an election that's underway. So you never know what the economy is going to look like. You want to be prepared on how to pivot. Always know how to pivot.
Yeah, love it. Okay, so you guys know how short-term rentals work. Rachel's works a little different. Like she said, own fewer, but squeeze all the juice out of it. Instead of having 50 mediocre, have 5 extremely profitable. That's going to give a higher ROI on your time and your money, like no brainer. And I love all the little tips that you shared. And just know, guys, like if you decide that Airbnb or short-term rental is best for you, I mean, Rachel's going to be the one to help you figure out how to squeeze all the juice. I was an Airbnb manager like 10 years ago when I had my babies, and I would manage other people's homes. But we did what you were talking about. We were near Facebook. So they were our client, not the individual people who were living there. But, having those corporate relationships for the 1 to 3 to 4 month time blocks, like, whoa, makes a world of a difference. All right. So let's run through the things. So we talked about how it works. Now, who is it best for? So why don't you take a couple minutes, say, who are short-term rentals best for? And then I'll say who syndication models are best for.
Awesome. So I love this question. Of course, I feel it's best for everyone. I'm just so biased. But let's be realistic. It is very much a hospitality business. So if you're an individual who understands that, and it's surprising to me. I have a doctor who's in our community who's super busy. She has a very busy practice. She's like, there's no way I'm going to manage this. There's no way I'm going to be able to manage it. I'm going to need all the resources, all the help. And that's why we started a concierge virtual assistant program to help with the guest communication. If you're performing a surgery, I need you to focus on that and not, oh, I didn't get my blow dried. We got you. But she was surprised at how her heart of wanting to deliver that patient care actually transitioned into this. She's like, I hope they're having a good time. I hope they saw the marshmallows. I'm like, who are you? Like, what happened? She goes, I know, and I need to get back to work. But she just really got into it. So if it really delights you to understand and respond to the pain points of individuals, I know when we travel, my husband and I, it's me, my husband, his adult siblings, their children, our parents, and my adult siblings, their children and spouses. We travel in a big group, and that's why we like the bigger homes, the 5 bedrooms, because you have about 4 or 5 paying units that can cover the cost of those higher nightly rates. And if you can actually walk them out in the shoes of that guest avatar, or if you can walk them out in the shoe of that traveling executive or of that travel nurse, and you understand that they're going to need blackout blinds, they're going to need, say it's a family, they're going to need a foosball table, say it's that family with small children, you're going to want to add a high chair or stroller because it's a drive-to market. There, by the time they fit all the things in the car, there's no room for people. The high chair, the stroller, the crib. If that's something to you that you feel is feasible, it's doable, you're even interested in it, there's a possibility there, because here's the deal. Even if you get to the point where you do not necessarily feel you can hack it, Sarah, you mentioned a little bit earlier, you were one of those managers who can come alongside. But I'm looking at this from a lifestyle investing perspective. I personally want to invest in things that I get to enjoy as well. So whenever I'm looking at homes, I'm like, would I want to stay here? Would I want to enjoy this, nice blender to make my smoothies? Would I? And we add things to those properties that actually are things that we would want to enjoy ourselves. And so the flexibility there, I think it's great. The fact that there are multiple ways to invest, I think it's great. So if you have that interest, if you have that heart that wants to provide hospitality, it's definitely for you. If you don't, it may not be, but if you're willing to find someone to partner with, it still can, because the model of property management and co-hosting is still there. And as far as a tax perspective, a lot of the members of our communities who are W-2 earners are leveraging cost segregation studies, bonus depreciation with short-term rentals, which I think is absolutely awesome. But we do know for short-term rentals, I'm not sure about multifamily, those numbers are reduced in 23 and 24. It's same. Okay. Yeah. So you can still leverage
so get it
that
now.
as well. I know. Get it.
Get it
We're
out,
looking at properties every day. Oh my goodness. Yeah. So we're looking to invest at least in one short-term rental for the next 3 years. But very much, I don't want to sugarcoat it. It is a hospitality business. Just know that going in for sure.
Yeah, I love it. Also on the who is it for, like, what about markets? So some people live in areas where there's a high volume of travelers, either for work or vacation. And so that's going to affect it, right? Other people live in areas where there's not a high volume of people visiting. So how does the market affect it? Because a lot of times people want to have an Airbnb that they can drive to that's within, a bubble radius. So what if you don't live in one of those markets?
Oh, I love that question too, Sarah. So There are different ways to invest in short-term rentals, and remote hosting is absolutely huge with the members of my community. I actually have members who are living in Hawaii. Is that going to be the most cost effective? Am I going to get my ROI in Hawaii right now? And then we have some regulatory restraints. So financial restraints and regulatory restraints. If you live in that higher cost of living area, or if you live in an area where it's just straight up banned, it won't work there, right? So what do we do? A lot of our members are actually investing remotely. I have a member in my community who has 3 short-term rentals right now. She lives in one state, all 3 are in another state. So how do you manage that? And so you do have to build out your systems, and part of your systems is a technology stack. So you want to have a noise aware monitor. So, once the decibel goes too high at the property, you get automated text messaging. You want to have an outdoor camera so that you can kind of validate who's coming into the property. You want to have keyless entry into the property where you can monitor that code remotely. We actually had a situation, it was a bad situation, where you can see that a party was going to be brewing. And so remotely, we locked them out. We locked them out, and the constable did show up to the space and help them grab their belongings and fully evict them. You're not coming back in. And so from another state, thank goodness for technology, because otherwise you would be anxious about having to fly out. And then, believe it or not, the backbone of the business is our cleaning team. Our cleaners double a lot as task rabbits, and they can help, grab and bring, something to the property. And then tools like Instacart. I mean, I ordered a hairdryer from Instacart. Yeah. Like, seriously, so like Instacart, you can order something if something's missing from the guest from an Instacart, and then it arrives there. So thank goodness for technology. It is very feasible, it's doable, but you want to be prepared, because things happen. It's not if things are going to happen, it's when things are going to happen, and all kinds of things happen.
So like when someone's deciding on a market that's good and strong, what's the typical amount of money people should expect to, have available to put forth to start this business?
Oh, I love that question, Sarah. Okay, so a couple of things. I would say, I don't know where we are with our 10% down loans, but there is a second home loan that we love to use. So if you're purchasing, and if you can qualify for a second home loan, it's called a second home vacation loan. It's an FHA loan. You have W-2 income, you would probably be able to get qualified. That's 10% down. So the amount of money would be at least 10% down for the property. And then the number of bedrooms, the square footage of the property would determine the actual furnishing costs. So furnishings can cost anywhere from, I would say, $5,000 per bedroom. So 3-bedroom home planned for $15K, but it depends on the level of your furnishings, because it can go upwards of hundreds of thousands of dollars if you're ultra luxury, which I do not recommend. But I would say anywhere from $5,000 per bedroom to up to $20 per square feet. So if it's a 1,000 square foot home, that wowould be $20K.
Awesome. So I heard you say something because I think that's really important. Not most of, but in thinking like what type of investments are good for people, someone's going to need to qualify for that loan to purchase a short-term rental. And so like my mom could not qualify for a loan because she's not working. So what she does is she invests in syndications because she has money. So she puts it somewhere and it's going to work for her and someone else is going to manage it. And so that's an interesting point I wanted to say, like, if you cannot qualify for a loan, not because you have bad credit or anything like that, but just because you don't have strong enough W-2 income, but you do have money to invest, you do have money in your IRA or your 401k, or, you have lines of credit on on other things, then those are, then it would be appropriate to say, okay, let's go into a passive investment where someone else, like Sarah, is the loan guarantor, and Sarah and her partners get the loan, and then, you would just help supply the down payment for the large commercial property. So that's also something to think about for you folks in the audience. So I'll say a little bit about like who syndications are really good for. Syndications are great for people who really want a big separation from any liability or responsibility. So like I said, in a syndication, you're not on the loan, you're not on the deed, so you're not out there like looking at individual listings. Some people love looking at listings, some people that gives them a headache. So if you don't want to go make purchases of a couple buildings or purchases of items, you're not a shopper. That sounds like a headache. Syndications are great because someone else, me and my partners, are doing that with your money for you. And so you can put your money in, you're not on the loan, the deed, you're just like, here, take it, work it. And so you're very removed from responsibility and work. Also, who syndications are really great for are people who live in locations where the economics of the market are kind of, I'll say, upside down. So for instance, I'm in San Francisco, California. If you buy a house, your mortgage is going to be roughly twice as much as what you could rent the same house for. So we did that. We sold our house. We invested it in a syndication, and the cash flow from that syndication pays our rent and other things more time over. And so oftentimes people who live in the high cost of living markets, it's hard to find rentals that can cash flow because it's so expensive to buy the properties. And so oftentimes people in those markets will either do like what Rachel said, have something remote and have a remote manager, or they say, that just gives me a stomach ache. It doesn't sound fun. Then they go into a syndication. You can live in California. You can invest in a syndication in Texas. You can invest in a syndication in Huntsville, Alabama, in South Carolina. And you don't have to worry about it. It's not in your market. You can choose markets that cash flow where the cost of the ownership is half the cost of the rent instead of vice versa. So it's really great for people who live in markets that are not good markets for single family home rentals or short-term rentals. I think that's like a good summary of who each is good for. Now I'd love to hit, let's say we don't have much time. We have 7 minutes left. So let's hear from the audience. What do you want to hear from first? Inflation or interest rates? We're going to talk about how that affects each of our investment styles, especially right now. Who wants us to talk about interest rates? I see both. I see interest rates. Hey, you guys, use the everyone function in chat so everyone can see what you're saying. I see a lot of people answering with just hosts and panelists. Interest, yes. Okay, we'll start with interest rates. Okay, or let's just call it in general, the lending space. So I'll start by saying what we're seeing in the lending space for multifamily. I'll give some very real examples. So one, we're supposed to close on a property. Like I said, I live in California. We're buying a property in North Dallas. Monday, we're supposed to close. Yesterday, the lender who has already committed to the loan, both in the amount of money they're giving us and the rate, yesterday they said, actually, we're going to give you 2/3 of that amount. So how can you decide this 3 days before we're going to close? That's the lending market these days. So now we're redoing the underwriting, trying to decide, okay, now we need 1/3 more money. What makes sense? Do we, go raise some more capital? Do we find a second level lender? Do we put our own money in? So it is a really funny time to be in multifamily because, a lot of people think of the interest rates going up. Well, this lender, the interest rate went down, but the amount of money they were lending us went down in the final hour. So it's actually getting harder and harder to find and close multifamily deals. We could just close it and say, okay, investors now you get less money, but we're not doing that. So the returns to investors are staying the same. Like if you want to be a passive investor, we're still going to maintain those same returns for you, but there's going to be fewer opportunities, I think, in the next like 4 to 6 months. But then what I think we're going to see, like Rachel was talking about in her space as well, is that sellers are going to start adjusting their the asking price or the price they accept. So Rachel's already seeing that usually multifamily and commercial trends lag what is going on in the single family home space. So whatever you see today in single family might be an indicator of what's going to happen in commercial in 6 to 9 months. So if we're seeing prices drop in single family, okay, maybe in 6 to 9 months, it's going to be great in the multifamily space. So what I see happening now is that the volume of projects in the volume of sales in multifamily is shrinking, but the prices aren't shrinking yet. The sellers are like, I'm just going to hold. I'm not going to sell then. But I think there's going to be a point where we still see those emotional and distressed sellers, and that's when we're going to pick up some really fantastic stuff in the multifamily space. So that's what the lending market and all its craziness is doing for us. It's reducing the amount of opportunities today, but I think it's going to present in 6 to 9 months a huge amount of opportunities for us. What about you, Rachel?
Yeah, and I love this conversation because I feel as though it's ever evolving, right? The things that lender's telling you, it would be absurd. Like, no, you can't just change, your mind on the amount. But we're seeing a lot of ever evolving, excuse me, ever evolving lending practices and products that are coming in and out as quickly as they're coming in, they're going out. So 3 things that I've noticed that, and I made note of in this market, and I'm actually looking to learn more, and I'm reaching out to some of the lenders that are specialists in the short-term rental space to come and speak to us a little bit more about it, because I'm not a lender expert, but there's one thing called a 2-1 buy down, and that is defined as a type of finances that lowers the interest rate on the mortgage for the first 2 years before it rises to a regular permanent rate. So that's what we're learning about now, because it's a cycle, it's a new wave, it's a new market. And so you need to learn what strategies are going to work in this particular market. The second thing that I'm looking at that seems to be something that's going to be working in market, not only are the sellers reducing their price, they're paying closing costs. That helps.
Yeah, that helps for sure.
That helps
my
a
sellers
lot.
would pay closing costs.
Yeah. So
It was a
seller
couple
pay
mil.
closing, that's going to be something that's a strategy in this market to learn about right now, to learn how to implement that. Remember, we were doing last market, we were doing something called I forget the name, but you give your max price, but then you'll allow them to incrementally increase because it was a bidding war. Well, we're not going through that now. So now ignore all of that. Things have changed. So seller pay closing is the second thing. And the third, oh, I'm sorry, I'm hearing a little feedback. And the third thing is first and second combos. So we're looking at those 3 things to really try to get the deal and to really make the deal work. So I hope that's helpful, but it is a different environment. And what I'm implementing myself is I'm dating the interest rate, but I'm going to marry the house, and then I think it's going to give us an opportunity to refinance in the future. So I don't know about how refinancing work all the way to, with multifamily, but refinance is huge. If we now have a market that can shift to refinancing, we have an opportunity to get a better interest rate down the line. So that's what I'm thinking, Sarah. What about you?
Yeah, exactly. And I see we're 1 minute to the top of the hour. So what I'd like to do, because I saw a bunch of people saying, how can I get in touch with Rachel? How can I get in touch with Sarah? So what I want to do is drop how to get in touch with us. And then I want to talk about how inflation is going to affect each of these types of investing in case there's people who have to drop off. So Sarah Paul, if you can drop in the 4-point investment strategy session. So what this is, you guys, if you look in the chat, you can click on the link, and it's a link to book a call with me. And what I'll do is basically go in depth in the slides that I took through, like how to decide what kind of investing is right for you based on your goals, your lifestyle. And then if it's appropriate for you, let's look at where you're going to find the money to invest, when to use your retirement funds, when not to. based on the tax strategies that I know. Obviously, you're going to want to go check that with your CPA after you talk to me. But we'll put together a little plan for you. And then if it's right for you to move forward with syndications, then we'll talk about the opportunities that we have. If it's like, okay, we figure out this is not right for you, then, I'll introduce you to someone who has the right type of investing for you. So I love doing that. This 4-point strategy call, I've done it with over 600 investors, and it's a really great way to make sure that you're investing in what's right for you, not just investing because it's the only thing that, you've been introduced to. So that's in the chat. And then Rachel, what's the best way for people to get in touch with you if they want to continue working with you?
Yeah, awesome. Thank you. And I do have a free resource for everyone. Question you asked is, where should you invest? How do you find the cities? And so 75gems.com, 75gems.com. It's an ugly spreadsheet, but everyone loves it because you get a list of cities, you get a list of their parameters and some of the numbers. Start to understand those numbers. It's ever evolving, guys. Remember, do your due diligence, understand the regulations. Last month's regulations may not be this month's regulations, but it's a great starting point to look at the parameters, the data points, and the numbers that I'm looking at. And if you want to learn a little bit more about the coaching program, I have my dot card with all of my things, where to follow me on social. So feel free to grab that as well.
Awesome. So everybody, that's in the chat, 2 links, ways to get in touch with us. And also when we send out the replay, we'll send you links for how to get in touch with us. All right. Do you have a few more minutes for the last question? Okay. So inflation, CPI index, that's redundant, but consumer price index yesterday, 7.7%. The last time it came out, it was like 11% increase. So like inflation and increasing cost of things, increasing cost of real estate, increasing cost of labor. How does that affect investing in general? Well, like it's definitely to be taken into account. And so I'll start by saying, in my space, how is that affecting it? Well, if the cost of buying a single family home has gone up at a higher percent than people's salaries have gone up, and in addition to interest rates going up, I mean, that's like a double increase on, so a lot of markets it is increasing. So some markets, the cost of a single family home is decreasing. Some markets they're increasing still. So being really focused on looking at this data for your market is very important. But say you're going to a place like Phoenix, where the cost of housing is still high, but did W-2 wages increase at the same amount that the cost of buying a house increased? No, it didn't. So there's still a large number of people who are looking to rent. There's still a large number of people moving to Phoenix for their new jobs. So they don't yet have their down payment. They do have their nice new salary, but the cost of buying a home is so expensive. So they still need to rent. Now, you just have to be really great with your numbers and make sure when you're doing your underwriting that you're forecasting and you're putting the increased cost of supplies into your financial projections, the increased cost of labor, if you're remodeling and stuff like that, making sure you have those increased costs in your spreadsheet, in your financials. So it doesn't mean that because there's, inflation and things are increasing in price, that it's not a good time to invest. It means you have to look at what those numbers are in your very, very specific market and make sure you forecast with a 7% increase, when you're looking at, remodeling. So like if we buy a 300 unit apartment building, we don't remodel everything in month 1. It's going to take 2 years to get through all those units. So we forecast, okay, so it's going to be 7% increase in cost to do the remodels of the units, to do the things that we're looking to do. And so you just need to make sure that you know what the numbers are as far as the inflation and the cost of doing your business, and that those are in your underwriting and your forecast. And then if the numbers work, then move forward. It's just like be really conscious of them. And then also often rent follows inflation. So real estate, and this is going to be true for most types of real estate investing, not just the two we're talking about today, but as inflation goes up, rent goes up. And so especially in what we're doing, properties are bought and sold like businesses, and businesses are bought and sold based on net operating income. So if you increase the rent, you increase your net operating income, it follows inflation, then the resale price is going to be higher. That appreciation at the exit is going to be worth it. So it can actually be a great thing if you're in the rental space. All right, I'll pass it to you, Rachel. What does inflation mean for short-term rentals?
Yeah, so that is such a great a lot of great points that you made, Sarah. So we are seeing similarly to what you're seeing with the workforce, so the pricing for workforce has increased as well. Like I mentioned a little bit earlier, those cleaning team members are the backbone of our business. So the price of workforce has increased. The ability to find workers that will work for, a more cost-effective rate has decreased. So you want to make sure that you are leveraging as many cleaning teams as possible. And so here's what we have done. We've actually allocated three plus cleaners for our properties, where initially we would have one cleaner and then one or two backup redundancies. Now we have more. Okay, you want to have more, you want to have backups. Another thing we're seeing in the economy, there's a great resignation, right? So if a cleaner decides, you know what, I want to live in Cancun for 3 months and no one's going to stop me, so be it. YOLO, right? Live your life. I fully support you, but I have a guest checking in also, and now I'm in a pickle. So having that backup is going to be really, really important, and keep that in mind. And so, Sarah, going back to the very initial, and I think it always goes back to the type of property and understanding your market and knowing what your margins are, because we're not going to overextend ourselves, and I love that you offer that session of what's going to be the best thing for you. It's comfort level. It's, we don't want investing to be anxiety driven 24/7, 7 days a week, 365, right? There's going to be some points, but we don't want that to be, the baseline. So really, again, investing in some of those properties where there's an opportunity to position that property as one of the top 5 in a market is absolute key, because those types of travelers that are looking for the best of the best, they seem to be not adverse to still paying those higher than expected rates. Some of the rates that we charge, I can't afford myself. I'm like, I'm not paying that. But you have this type of traveler, this avatar, who is not averse to paying those higher rates. They're traveling in perhaps a group of 2 or 3 or more, where you have all of these adults who can split the risk, which is great. Or it could just be, a single individual with, family of 3 who is affluent, and they are paying those nightly rates. So although the inflation is there, positioning yourself, you're positioning, making sure that you're not setting it and forgetting it. You want to make sure that that property is well maintained, well taken care of. You're leveraging those 5 pillars that I mentioned, the upsells. You're leveraging whatever you can to put that property on the map, so that you can get those guests to book your property again and again and again in the future.
Awesome. Well, thank you, Rachel. I'm going to say, let's go ahead and wrap. And I'd love to say thank you so much for your time. And if you guys are thinking of doing a short-term rental, definitely get in touch with Rachel, follow Rachel, because it's like the smart way to do it. And it's going to give you a higher ROI on your time, which I think is most important. I mean, a high ROI on our money is important as well, but you want a high ROI on your time. You want to maximize each property so that you're not having like 10 Airbnbs when you could only have 5 and have the same profit, right? And because we're all investing for lifestyle, we're all investing to have more cash flow today or more money later. And we're not investing because we just, want to use up our time. I mean, maybe some of you are, but not likely. So I want to say that, and thank you, Rachel, because you have so many, you guys heard a few gems She has so many other ways that she can help you improve. Even if you already have Airbnb, I saw some people on here saying like, hey, I just bought one. What's the best way to set it up and stuff like that? So she's great. Get in contact. And if you're like, that was a lot of stuff. I don't actually want to be that involved. I want to be hands off. I want to be in some other market. I want to be able to just, go to Cancun and not think about it for months at a time. Passive investing could be great for you. Also, if you don't have W-2 income or you want to use your IRA or your 401k, something passive like a syndication with me might be more appropriate for you. So I want to say thank you for coming, and you have our information. Replay will come out tomorrow, and we'd love to continue the investing journey with you guys. So please do be in touch with us and ask us whatever you want. We'd love helping people on their journey to create the lifestyle they want through investing in real estate. All right. Well, thank you, Rachel. And with that, I'll say have a great day.
Thank you so much. Bye-bye for now.